You know, when you hear the words legacy department store, I mean, it is incredibly easy to picture a relic of the past.
Oh, totally.
Think about the last time you walk through a traditional mall. You probably imagine like cavernous, quiet aisles, way too much perfume in the air, and a business model that feels like it's been slowly fading since the invention of the internet.
Right, the classic retail apocalypse narrative.
Exactly. But today we are going to completely flip that script. Welcome to the deep dive. We are looking at a masterclass in modern corporate turnaround, and we've gathered a really fascinating stack of sources for you.
Yeah, we've got the Macy's Q4 2025 earnings report, the accompanying slide deck, and the official earnings call transcript from March 18, 2026.
And the mission for you listening today is simple. We are going to extract the aha moments from a financial report that genuinely shocked the market.
It really did surprise people.
We're going to figure out how they're heavily publicized. A bold new chapter strategy is actually working, why luxury and real estate are, secretly driving the bus here, and what their future guidance tells us about the broader economy you and I live in every day.
It really is a fascinating pivot to analyze. Because for years, the prevailing narrative around physical retail, especially those massive department stores anchoring suburban malls, has been incredibly gloom.
Oh, super gloomy.
The assumption was just that Amazon and direct-to-consumer brands had permanently won. But the data we are looking at today tells a completely different story of adaptation. It shows how a legacy brand can actually rewire its internal mechanics to survive.
Let's start at the 30,000-foot view, focusing on the headline numbers that had the market doing a double take.
Yeah,
Because Macy's completely crushed expectations.
they really did.
In Q4, their adjusted earnings per share came in at $1.67, and the consensus from Wall Street analysts was only $1.55. Plus, total revenue hit $7.92 billion, easily beating the expected $7.48 billion.
Those top-line revenue beats are impressive, but the underlying health indicators are what really stand out in this report for me.
Like what?
Well, overall, company comparable sales grew 1.8%. And for anyone listening who might not follow retail metrics super closely, comparable sales, or comps, simply measures the revenue generated by stores that have been open for at least a year.
So it strips out the artificial growth you get from just opening new locations?
Exactly. It gives you a true picture of whether people are actually buying more stuff at the existing stores.
Yeah.
So a 1.8% bump in a tight economy is significant.
That makes a lot of sense. It measures the actual pulse of the current stores. And maybe the most staggering number to me in this whole report, their full-year free cash flow was $797 million.
Yeah, that is a huge number.
They note that's a 15% yield. To translate that finance speak, it basically means for every $100 you invest in the company's stock, they are generating $15 in pure, unencumbered cash after paying all their operating expenses and maintaining their buildings.
Which is a massive cushion.
Right. They ended the year sitting on $1.2 billion in cash, they authorized a 5% dividend increase, and they have a $1.1 billion share buyback program. Okay, let's unpack this. Turning around a 160-year-old retailer like Macy's is like trying to do a handbrake turn in a massive ocean liner.
That's a great way to put it.
It shouldn't be physically possible. You don't just drift a cruise ship, yet these numbers show the ship is actually pivoting. How are they physically doing it?
What's fascinating here is that this is absolutely not a fluke or just like a lucky holiday season. It is the direct result of a highly disciplined strategy they call a bold new chapter.
A bold new chapter.
Right. What the executive team, led by CEO Tony Spring, realized is that they couldn't just be one thing to one type of customer anymore. A monolithic approach sinks ships in today's economy.
So they split it up.
Yeah, they leveraged a multi-brand, multi-category, and multi-channel model. They have the core Macy's brand for the middle-class consumer, Bloomingdale's for luxury, Bluemercury for premium beauty, and Backstage for off-price bargain hunters.
They basically built an all-weather ship.
Precisely. In a highly volatile consumer environment, having that diversified portfolio acts as an incredible hedge. When inflation bites and one consumer segment tightens their belt and turns to Backstage for deals, another segment might still be spending freely.
Like the luxury shopper at Bloomingdale's.
Exactly. It smooths out the massive peaks and valleys that usually destroy retail profit margins.
Okay, so if the top-line numbers are up across this all-weather ship, we naturally have to ask where inside these massive stores is that growth actually happening? Because it's not happening equally everywhere.
No, definitely not.
Looking at the breakdown, Bloomingdale's was the undeniable star of the show. They posted their best holiday performance on record. We are talking about a 9.9% comparable sales increase in Q4.
Which is huge.
Almost 10% growth in a single quarter for a luxury department store. Meanwhile, the core Macy's business relies on something they call the reimagined program. They have 125 of these reimagined stores, and they saw a 0.9% bump in sales. And management is apparently thrilled with this, to the point where they are rolling out 75 more, creating the reimagined 200. That's going to make up 60% of their go-forward fleet and 75% of their total sales.
We also saw some huge merchandising wins across the board that fueled these numbers. Contemporary women's apparel and beauty and fragrances did incredibly well.
Yeah, I saw they brought in buzzy new brands like Toteme and Skims at Bloomingdale.
Well, right. They are leaning hard into what the industry calls a good, better, best barbell pricing strategy.
A barbell strategy, okay.
Yeah, so you offer strong opening price points on one end of the barbell to capture the value seeker, and then highly sought-after premium brands on the other end to capture the luxury shopper. You avoid getting stuck in the muddy middle where retail brands usually go to die.
I hear that, but I have to play the skeptic here for a second and push back on these numbers.
Great point.
Bloomingdale's is up nearly 10%. The core Macy's Reimagined stores, which is the flagship brand everyone thinks of, are up less than 1%. Is the Macy's brand just riding on Bloomingdale's luxury coattails?
That's a fair question.
Like, are they simply using the high-end luxury sales to make the overall company spreadsheet look good, while the core business is basically just treading water?
That is the exact question a lot of analysts ask when they first glance at the earnings, but it fundamentally misunderstands the physics of a legacy retail turnaround. You have to look at where that core Macy's brand was a few years ago.
It was tanking, right?
It was actively contracting. Achieving a 1% growth in those 125 reimagined stores is actually a massive, hard-fought victory because it proves the bleeding has stopped. Halting that decline meant changing the physical DNA of the stores.
But how do you change the physical DNA of a massive department store without shutting it down entirely?
You focus on the friction points of the customer experience. The mechanics of the reimagined turnaround are deep. They didn't just slap a new coat of paint on the walls.
What did they actually do?
Well, for one, they are adding dedicated staff to the floor. Now, paying more employees costs the company money up front, but it dramatically drives up conversion rates. Shoppers aren't abandoning their carts when they can't find someone to unlock a fitting room.
Oh, I hate when that happens.
Right. They're also hosting highly localized events. The report mentions their Prom Starts Here activations, which successfully brought teenagers flooding back into physical stores.
Which is a demographic many assumed was lost purely to TikTok shops.
Exactly. Furthermore, they are drastically improving their visual storytelling so the merchandise looks premium, and they are ruthlessly clearing out aged inventory. When you walk in, the store feels fresh, not like a warehouse of last season's leftovers.
So stabilizing that massive, slow-moving core business at Macy's while simultaneously letting the high-margin luxury wing at Bloomingdale's absolutely soar is the ultimate goal. The luxury wing generates the excitement and the high profit margins, while the stabilized core provides the massive scale and cash flow. It's like having a reliable, dividend-paying blue-chip stock in your portfolio right next to a high-growth tech stock.
That's a perfect analogy.
They serve completely different purposes, but together they make you rich.
That portfolio balance is key.
Speaking of high margins and cash flow, here's where it gets really interesting. When you read through the earnings transcript, you realize Macy's isn't just a place that sells pants and perfume anymore.
Not at all.
There is this entirely hidden ecosystem operating beneath the floorboards. They have this revenue category on the ledger called Other Revenue, and it was a massive bright spot.
The other revenue numbers were wild.
Yeah. Their credit card revenue jumped 17.1% to $205 million because their customers currently have a really healthy credit portfolio.
Yeah.
But even wilder than acting as a regional bank, there's the Macy's Media Network, which grew 12.5% to $72 million.
The media network is perhaps the most underappreciated asset in their entire portfolio.
Completely underappreciated. They have a database of nearly 40 million active customers. That gives them direct visibility into 70% of all their transactions.
Which is a goldmine.
They know exactly who is buying what, when, and in what zip code. Let me explain how this works for you listening, because it blew my mind.
It's pretty clever.
Because Macy's has this incredibly deep, localized first-party data, they can go to a brand like Estee Lauder and say, hey, we have 2 million shoppers who reliably buy premium anti-aging cream every 6 months. pay us, and we will put your new product directly in their digital feed and in their email inbox.
It's highly targeted.
Yeah, Macy's is quietly acting like a Silicon Valley tech giant, turning retail shopping data into high-margin digital ad revenue.
If we connect this to the bigger picture, this hidden ecosystem is the secret engine of their entire turnaround. Retail profit margins on a physical piece of clothing are notoriously thin once you factor in manufacturing, shipping, and store overhead.
Right, clothes don't make that much money.
But the profit margins on credit card interest and targeted digital advertising, those are incredibly high. The cost of acquiring a customer on a platform like Facebook has skyrocketed for brands, making Macy's internal, highly targeted data a goldmine.
So it's basically a massive subsidy.
Exactly. This alternative revenue provides an enormous financial safety net for the physical stores. And crucially, it affords Macy's management something that is incredibly rare on Wall Street: the luxury of patience.
Wait, patience with what? Their real estate?
Yeah, let's look at their fleet optimization strategy outlined in the slide deck. They announced they're intentionally delaying the closure of about 65 underperforming stores until 2028.
Wait, normally when a retailer identifies dead weight, like stores that aren't hitting their numbers, Wall Street demands they shut them down immediately to stop the cash burn.
Exactly. Usually it's a race to close them.
Let me puzzle this out. If they aren't desperate to sell off the real estate right now, it must be because the commercial property market is currently sluggish due to high interest rates.
You're on the right track.
Wait, so by sitting on these 65 dead stores until 2028, they're basically acting as a commercial real estate holding company, waiting out the high interest rates.
The math backs that up entirely. Because they have such strong diversified cash flow from the credit cards, the media network, and those thriving reimagined stores, they do not have to endure a fire sale of their real estate.
So they can afford to wait.
They can simply sit on those properties and let them mature. Their stated goal in the earnings call is to eventually extract $650 to $700 million in total asset monetization from these closures.
Wow.
The report notes they have about $250 to $300 billion left to collect, which equates to roughly $1 per share in pure value for investors. They're intentionally waiting until 2028 to extract maximum shareholder value, knowing that once those 65 stores are sold off at a premium, they will be left with a highly optimized, highly profitable fleet of about 350 physical locations.
That is a wild paradigm shift for anyone who follows retail. The physical store isn't a liability dragging them down. The real estate itself is an asset they are just letting marinate until the market is hungry enough to pay top dollar.
It's a very smart play.
Okay, so we've established that they had a blowout quarter. The luxury wing is flying. The core is stabilized. They have a secret ad agency and a bank printing cash in the basement. And they are playing 4D chess with their commercial real estate.
Right.
Which begs the final million-dollar question from this entire deep dive. With all of this incredible momentum pushing them forward, why is their guidance for 2026 so incredibly cautious?
The mood music of the Q4 report is triumphant, without a doubt, but the 2026 forecast is highly muted. It presents a stark contrast that we really have to decode.
Very muted. For 2026, they are expecting net sales to basically stay flat, hovering around $21.4 billion to $21.65 billion. They are projecting comparable sales to be somewhere between negative 0.5% and positive 0.5%.
Basically flatlining.
Yeah, and they expect their adjusted earnings per share to actually drop down to between $1.99 and $2.10. When you dig into the why behind this conservative forecast, you immediately hit a massive external headwind in the data tariffs.
The economic reality of importing physical goods from overseas is inescapable in retail.
And according to the report, tariffs already cost them 60 basis points in their Q4 gross margins. For anyone not staring at a Bloomberg terminal, a basis point is just finance speak for 1/100th of a percentage point.
So it's 0.6%.
Right, a 0.6% hit to their margins, which translates to millions of dollars at this scale. Looking ahead to 2026, they are modeling that tariffs are expected to shave 0.10 cents, $2.20 off their earnings per share for the year, and hit their Q1 margins by another 40 to 60 basis points.
It's a significant operational hurdle.
And alongside the supply chain costs, there is the raw consumer behavior data. Their average unit retail, which is essentially the basket size or the average price per item, is going up, but the actual unit volume, meaning the physical number of sweaters and shoes people are buying, is slightly down.
Which tells us a lot about the consumer.
The data shows their upper-income shoppers are incredibly resilient, absorbing the higher prices without flinching, while the lower-income shoppers are becoming, as management phrased it, highly choiceful.
Choiceful, yeah, that's the corporate term.
And finally, to combat all this, they are leaning heavily into tech. But not the flashy stuff. They're implementing over 35 specific AI use cases across their supply chain, merchandising, and customer service. So, what does this all mean? Wait,
hmm
let me just ask this. If Macy's is relying on higher prices per item to drive revenue, and they are leaning heavily into AI to cut costs, are they at risk of totally alienating their core, budget-conscious, middle-class shopper? The exact person who is already feeling the pinch of inflation and the trickle-down effect of these new tariffs.
This raises an important question about how a modern corporation navigates complex economic turbulence. The answer lies in understanding what prudent guidance actually means in the context of corporate finance.
Okay, break that down for me.
Management isn't saying the sky is falling. They are actively building a shock absorber against macroeconomic volatility. Look at how they handle the tariffs. By baking the absolute worst of the anticipated tariff impacts into the first half of the year, particularly Q1, they are establishing a very safe baseline.
So they're preparing for the worst.
Exactly. If the global trade environment softens or exceptions are made, Macy's beats expectations and the stock rallies. If the trade environment remains harsh, they've already prepared Wall Street for the hit, preventing a panic sell-off. It's a calculated strategy of underpromising to preserve operational flexibility.
Because it is always better to pleasantly surprise the market in August than shock them with a massive miss in April.
Exactly the playbook.
Yeah.
And regarding your concern about alienating the middle-class consumer with AI and higher prices, this is where their specific tech strategy is actually brilliant. Notice that Tony Spring explicitly stated they aren't chasing shiny objects.
Right, no gimmicks.
Right. The AI they are deploying isn't consumer-facing. You aren't going to walk into a Macy's and find a holographic robot trying to sell you a pair of jeans.
Yeah.
The AI is purely predictive modeling used for behind-the-scenes efficiency.
But how does that actually keep prices down for the consumer?
Consider their new massive distribution center in China Grove. They are using AI to look at historical weather data, localized trend cycles, and complex shipping delays.
Oh, to manage inventory.
Exactly. The AI ensures that a specific store in a specific zip code gets the exact number of medium-sized green sweaters it will actually sell. By perfectly matching localized supply with localized demand, they eliminate the need to put thousands of unsold sweaters on a 70% clearance rack 3 months later.
And clearance sales kill profits.
Clearance sales are a massive drag on gross margins. By avoiding that drag through AI logistics, the company saves money. Those savings allow them to maintain that good, better, best pricing barbell we discussed earlier.
Ah, it all connects.
It protects the opening price points for the choiceful, lower-income consumer, while simultaneously offering the premium products that are driving up the average unit retail for the luxury shopper.
To bring back our nautical metaphor from earlier, they've fixed the engine room, the ship is moving smoothly, but they can see a massive fog bank of economic headwinds on the 2026 horizon, so they are proactively easing off the throttle. They are prioritizing steady navigation over reckless speed.
A highly accurate assessment of their 2026 posture.
To wrap this all up for you listening, what we've uncovered today is that Macy's is no longer just a traditional place to buy clothes. They have executed a brilliant barbell strategy.
Truly brilliant.
On one side, they are capturing the highly resilient luxury market with record-breaking growth at Bloomingdale's. On the other side, they are meticulously revitalizing their core Macy's stores through the localized reimagined program, adding staff and fixing the physical customer experience to stop the bleeding.
And funding it all creatively.
Yes. That entire massive operation is being quietly underwritten by a hidden, high-margin ecosystem of credit card portfolios and an internal media network that monetizes their massive pool of first-party data. It really is a powerful lesson in corporate adaptability.
The broader takeaway is that with the right data utilization and a truly diversified model, even the oldest legacy brands can completely reinvent their underlying economics.
Which leaves us with a final, somewhat provocative thought for you to mull over as you go about your day. If a 160-year-old department store is now making hundreds of millions of dollars from an internal digital advertising network, managing healthy consumer credit portfolios, and acting as a strategic commercial real estate holding company waiting out market dips, are we witnessing the end of pure retail?
It really makes you wonder.
Maybe the future of the physical department store isn't actually about selling products at all. Maybe the physical store, the racks of clothes, the perfume counters, the makeup tutorials is just the shiny lure. And the actual business is a massive data acquisition center designed to fuel a hidden digital and financial empire. They managed to pull off a handbrake turn with an ocean liner, but maybe they aren't even sailing on the ocean anymore. Until next time, keep digging beneath the surface.